everyone, and thanks so much for joining us for the InvestSMART Bootcamp Week 1 webinar. So you might have already gathered that although the bootcamp's been running and it runs at a pace which you can do yourself, so it's self-led, we do have a 4-week type of time frame where we're looking at different topics, different modules in that order. And this is the second time we've done the week 1. So it's already been 4 weeks since the last one. So you can actually watch the previous week 1 and other weekly webinars that we've covered, covering off the topics in case you wanted to go ahead at your own pace. But this week, it's the week 1 topic that covers module 1 and 2. And we've had a lot of questions that have been submitted before the actual live webinar as well, which is fantastic. So you can always ask questions during this, and it's a really good opportunity if you want anything clarified or even explained in, I guess, more straightforward terms. It's a good opportunity to do that. And you can do that on the right-hand side through the control panel for the GoToWebinar. There's a little questions area, which I monitor as we're going through. And there's also the opportunity just to even make comments. So if you've got any comments you want to pop in there, definitely do that and let me know how we're going, whether or not you're encountering any problems. If I can't get to your question during this, whether because we run out of time or if it's a question that requires a more detailed answer, I can get back to you after the webinar. But as always, this will be saved and uploaded to the Bootcamp website itself, and we'll put it under the module 2 diversification. So as always, there's a disclaimer, and it basically is saying that we can't give you we can only give you general advice, not any kind of personalized advice. So definitely take that into account when you are asking questions, and we'll deal with it as we go through. So I'm Tom Wilson. I'm one of the product specialists at InvestSMART, and I look after the bootcamp as well. I've got an interest in increasing financial literacy in the broader community. Just like our chairman of InvestSMART, Paul Clitheroe, he's on a board of the Financial Literacy Board for the government as well. So I share a similar belief as he does, and I really do think it's something that should be taught in schools. So no matter what age you are, if you are taking this course now, you've made a really good, important first step of just understanding the basics. So this webinar is going to cover questions from the learning material. As I mentioned, we can't give financial advice. So if you ask a question like, I'm about to retire, should I invest in X asset? I won't be able to answer that, sorry. We'll have to just give you like a very general type of response that's in line with the course content. So we do need to stick to that, which just means that if we get questions that talk about, say, strategy, for example, that's in an upcoming week. So I'd probably have to refer you back to that. I'll try and look at it if we've got time, but just because of time constraints and just sticking to relevance as well. The other thing with these webinars is just checking in to make sure that you're using all the available resources that you have available. So that's in particular, you get a 1-month free access to Intelligent Investor and Eureka Report. And there's actually a lot of stuff that's on there that can help you with the bootcamp. So we'll run through that anyway during this webinar. So just remember that this is just an introductory course. It's not designed to replace any kind of first-year university course or TAFE course. And we're just covering the basics. So we won't go into anything too complex or any kind of stuff that maybe would be difficult to understand and take away the actual core reason why we're doing this. So as I mentioned, there's Eureka Report, which is headed by Alan Kohler. So you might have seen him on ABC each night going through his little charts and giving maybe a bit of a lighter side look at the economy. He's definitely been in the news quite a bit recently, talking about various different theories, talking about obviously the recession and other I guess, news related to this pandemic we're going through. So that's been quite interesting. But he writes obviously for us. Eureka Report's his baby, and he interviews a lot of CEOs and other people involved in the startup of companies. So it's a really good way to get insight into what they're thinking, because he directly asks them questions and presses them on a lot of issues that a lot of us are wondering about. There's a whole pool of experts that work with him, and they write with him as well, provide info. In fact, to make it a bit easier, I'll just jump to the website. So you've got obviously the InvestSMART website here, and Eureka Report. It's just at the top black bar here. So if I were to click on that, it would take me to their website. And obviously, you've probably seen this. You've got a lot of different articles here written by various contributors. And you've got obviously the weekend brief that Alan does. One of the best things about having access to Eureka Report is the Ask Alan segment. And this is something that we definitely recommend you do. So each Thursday, Alan gets all the questions that are asked by subscribers, even boot campers as well, and he'll look to question them. He gets a lot, obviously, so he can't always answer every single one. And ones that he has spoken about before, you can actually go through here and see all the ones he's spoken about. So he's even talking about here, 2 weeks ago, ETF portfolios for kids. I've not read that myself yet, so that would be quite interesting to see his take on it. And even talking about ethical investing and so forth. So there's a lot of information on here. And he was talking about the theories here, like MMT. He's been talking about this a lot on the ABC and also in the Australian, who he writes for still as well. It's quite interesting at the moment. It's quite complex at the same time. So I'll leave that to your own devices to get through that, because there's so much information here. It's definitely worth spending a bit of time and looking at it. There's filter tools, so you can filter through looking at different shares based on different criteria. Directors' interests is very interesting as well. Seeing what directors of companies are selling out or buying in to their own company, which they're required to advise the ASX. So that's all listed there. You've got announcements and other filter tools here as well that are very handy. There's also a section here called Super Advice, just talking about superannuation, particularly if you have a self-managed super fund, SMSF. Markets and strategies are always quite interesting. We get a lot of questions at InvestSMART about what is our view on gold. We don't really talk about it too much, but Eureka Report does. They've got commodities here, and they do go through a lot of that stuff. And all the charts that Alan talks about on the ABC each night, he actually uploads them here under charts. So they're amazing. They're really quite interesting. I find this one of the best things about Alan's reporting is that he can make a chart of anything. So I'm sure you've probably seen it before, but definitely have a look. And on top of that, you've got all the actual articles that he and his journalists or experts talk about. There was one that was actually released today. It's called Private Debt's Double-Digit Returns. So Elizabeth Moran, she talks a lot about bonds and different kinds of investments like that. And some of the questions I got before this webinar was live was a question from Leo saying, are there any asset classes that you would recommend taking a look at? We do stick to a certain number of asset classes in this course just because they're covered off by the kind of philosophy that we're trying to, I guess, get across, trying to keep it simple. Eureka Report and even Intelligent Investor, which I'll look at briefly, they do go into some of these other asset classes. And here's an example where private debt is an example of something that you could consider. Elizabeth does go through this in a lot of detail, which is really good. She talks about the risks, the advantages, disadvantages. Private debt, it's usually investing to private companies. So, for example, she gives examples here talking about different companies that are doing property development in different states. And you could consider something like this, but there's others at the top here, markets and strategy, and she talks, well, the experts here talk about property, fixed interest, commodities, and just markets in general as well. So the other resource that you've got, and you should definitely take advantage of, is Intelligent Investor. So Intelligent Investor, it has a value investing philosophy, and you've got analysts that are working behind the scenes, giving you their research, but also giving you their latest recommendations on ASX stocks. So let's have a quick look at that as well. As I'm going through, if you've got a question, definitely pop it in there into the side, and I'll stop and take a look at it for you so we cover off everyone. So basically, Intelligent Investor at the top here, there's a little black bar. Here we go. So you've got obviously research that they talk about. If they're covering a particular share, particular ASX stock, such as the Sydney Airport, you'll see their little recommendation here as well. So at the moment, it's a hold. If you want to find out more about what they will mean, if you go up to recommendations, you can go to value investing, and they talk about what value investing is, what's their method behind it. And we talk about this as well in the bootcamp in later modules. But what they do is they also explain what the recommendation types mean. So you might see things like speculative buy, hold. What does hold actually mean? So they go through it for you here. So that's under recommendations. But if we were to look at the recommendations, I can go to latest. And this will give us all the latest recos that they've done, and also the dates as well, plus any other pertinent information here too. You can see they talk about a max portfolio weighting. That's what they suggest the maximum should be in your portfolio. And that, I guess, comes back to diversification, which we'll talk about in this webinar today. They've got their own filter tools as well. And you can see that here in stock screens. Some of them are very similar to the Eureka report. In fact, they probably share the same information. Portfolios is very interesting. So what the Intelligent Investor does, they have an actively managed series of portfolios, and you can do this in two ways yourself. And we'll cover off this as well in an upcoming webinar. It's talking about active, passive, and all that kind of stuff. But if you ever wanted to see what they do to get an idea, you can actually go to model portfolios. So these are like their example portfolios. Let's click on growth, for example, and it will show us what they've got inside their growth portfolio. So they give you a bit of an explanation, and then they show you their breakdown, and they show you what sectors and then what specific stocks they're investing in. If you didn't want the hassle of having to log on to this page like each day, watch their changes and follow them that way, you can do it in other ways. So you can actually, the equity growth, which is a managed portfolio, so someone else does it for you, it will reflect that same portfolio. So it's got a lot of information here as well. And we do cover this off in upcoming webinars and course material. So you can always read ahead to and read about the difference in these portfolios. But basically, to sum up that little section, it's a lot of information in Intelligent Investor and in Eureka report, and you've got the 4 weeks access if you're not already a subscriber. So definitely take advantage of that and see what it's got to offer. I spend hours myself on it, just reading all the content, and they're approachable. You can ask analysts questions, usually on the research pages that they publish. You can actually comment below and ask some questions directly, and they get back to you. Okay, so just to get started on the actual module itself. So module 1 is about investment planning. So predominantly, we're going to look at goal, time, and risk profile. You need to have a reason as to why you're investing. And my experience, my background, I used to work at a broker where we offered a number of different types of assets or investments that people could trade on, covering off things like commodities like gold and oil, to shares, international shares, Aussie shares, and even cryptocurrency, even foreign exchange. And the principle holds true there as well. We used to say to a lot of the traders or investors, what's your reason for doing this? What are you trying to do? A lot of them would come back with, oh, I'm trying to either get rich or try and grow my wealth. But you need to have specific targets. You need to have a specific reason and adjust your risk and time frame around those. So a lot of those people, unfortunately, didn't do too well because they didn't have specific goals. They just had very broad goals and they didn't have any kind of time frame or risk profile associated to it. So I'm going to use an example. I'm trying to save up for a house deposit, and that's my goal. A house deposit, I want to have a certain amount of money put aside so that when the opportunity arises, I can jump in there and live the great Australian dream. So the next part is the time. So how long do I have, or how much time do I need? So how long do I have could be a reason for, say, if you were taking a trip, you wanted to save up for a once in a lifetime trip. Is there a time frame that's imposed on you? Do you have a certain amount of time where you have to save or have that money ready? In my case, it's how much time do I need? Well, I want to buy a house in 3 years, so that's my time frame. So I need to understand that I've got a 3-year time frame, and I need to structure any kind of investment decisions that I make around that time frame. So this third part is risk. How do I feel about risk? Will it keep me awake at night? So one of the biggest problems that we see with a lot of people who invest is, say if they've got the same goal as me, saving up for a house deposit, but they might get a little bit impatient or a bit greedy, unfortunately, and they look at investments that are higher return, but inherently higher risk as well. So they only look at the return and they say, oh, that's great, I can get 6% each year. That means it'll grow at this pace, but they forget about the actual risk of the investment, where usually a longer term, higher risk does require that extra time just to balance out any kind of years that might be down. And you could look at even this year in particular, at 2020, it's likely going to be one of those years made up with all the other years that go in it. It could be the negative one, but the others would hopefully be the positive to outweigh that. And we'll look at ways that can be mitigated or reduced, particularly through diversification. So my example, going back to my house deposit, is, so I want to buy a house in 3 years, but I don't want to go backwards. So I don't want to lose money. I don't want to be worse off than where I started, because I could have just left my money in the bank, got a really, really low return because it's risk-free, but I basically would still at least have my initial amount plus a little bit more. So my risk, how do I feel about it? Well, I don't want something that's going to wake me up, make me think, oh, gee, should I have done that? I'm going to hop out of that investment. Because when you chop and change quite a bit, you rack up a lot of charges like brokerage or any other kind of fees as well. So you might see that risk is usually given these terms. These are InvestSMART portfolios, and I'll talk about the InvestSMART ones just because I'm familiar with them. There are a number of different other kinds of managed portfolios or investments you can look at, and I'll even show you where you can search for those. But this is an example here where conservative portfolio, the InvestSMART Conservative Diversified Portfolio, has a suggested time frame of 2+ years. So what it's saying is that it recommends that you have your money in there for 2 years or more. If you go to the balanced, it's saying a 4+ year time frame. So for me, if my time frame is 3 years, I probably shouldn't be looking at the balance because it's suggesting to me I should have it in there for at least 4 years to balance out any of the ups and downs. So what I'll quickly just do is just to give it some context, I'll show you what I was talking about. On the InvestSMART website, you've got Invest With Us and you've got diversified portfolios. I'm just going to click on Invest With Us just to give you an idea here. So these are the 4 that I was talking about there. And it is quite easy to get, I guess, persuaded by just looking at the performance. But what we need to remember is that it needs to come back to those 3 core investment principles: the goal, the time frame itself, and the actual risk profile. So for me, I have the 3-year time frame. I'm not going to look at any others here. I'm going to look at the 2+ year time frame. That doesn't mean I can't have multiple goals. So for example, I might have alongside this a goal of just building my wealth. So when I retire, I'm in my 30s, so that's going to be a while off yet. So I could consider alongside this some kind of portfolio that has a longer time frame. And down the track, we'll also talk about how to look at this in terms of strategy, how to look at putting investments like this alongside other ones that are a bit more active. So we've got a question here from Sahar, just saying, do you have options for those who are looking to invest but also save tax on the returns, such as investment bonds and education saving plans? So InvestSMART itself only has the managed portfolios, and the intelligent investor has its managed portfolios too, or you can also purchase some of their ETFs, exchange traded funds, through the ASX, so through the Australian Securities Exchange, so on the stock market. And they've got 2 codes, there's INIF and INES. So when it comes to saving tax on the returns, whenever you get a distribution or a dividend paid back to you, there's the possibility of franking credits, which you can look into as well. And there is an article on Eureka Report talking about franking credits, but also talking about taxation as well. We don't offer any kind of investment bonds ourselves. I know that Elizabeth Moran, she does talk about investment bonds. So what I would probably do is just refer you to, if I go to the experts and go Elizabeth Moran, you can see all her articles here. And she talks a lot about different kind of bonds or other investments as well. But the long and short is that InvestSMART themselves don't offer any kind of investment bonds or any specific vehicle that's trying to save you tax on the returns itself. We do offer on the managed portfolios, you can actually set up an account for children. So, and that's been very, very popular actually. Recently, we've had a lot of inquiries about, from grandparents and parents and uncles and aunts about setting up accounts. So you can actually set up as a trustee for a child, or even like a joint trustee. So, parents of children or grandparents. So that's possible as well. The thing about the InvestSMART portfolios, we cap our fees. So it starts up at $99 per year to manage it. But as soon as you go over $82,000 in terms of your investment size, you'll only pay $451 per year. So that's one of the things that we do. But in your research, you should always look at whatever you're going to invest in, what are the fees? We're pretty confident that this is like an industry first. So we do say definitely compare other investments to this, but fees are very important. Obviously returns are as well, and risk. So have a look at that before making any kind of decision. Got another question here as well from Miles, asking, what do you do if you have a series of future goals over a period of, say, 2, 5, 10 years, and not just one goal? That's an excellent question. That goes to the core of exactly what this course is trying to show you as well, because you don't just have one goal. And as I was going through before, I've got multiple goals myself. So I've got the goal to save up for a house deposit. I want to put some money aside for my nephew's education. It'd be great to help pay for his university when he reaches that age. Then there's the very, very long-term goal of retirement, which I'm trying to save for as well. So for me, what I would look at is, and this is hypothetical because I'm talking about our products here as well, so you can always look at different ones, and you can even use the tools that we've got here. We've got calculators that show you different reasons that you might want to have different goals. And as they put saving for a happy retirement, you probably never would save for an unhappy retirement, but I guess that's just the marketing. But you've got to compare your fund here as well. So this is really handy when you are comparing other funds. It'll actually show you against ours, but you can type in the fund name or the fund manager, or there's even an APIR code. So if you're already invested in a fund, they should have given you, or you can ask them for the APIR code. And once you get that, you can type it in here and it'll compare the funds, the fees, and the returns as well. So for me, if I was to say I've got all these separate goals, one thing that InvestSMART does as well, say if I had to do conservative and I had to do a high growth for my long-term retirement, but then I wanted to do a 5-year one, say for my nephew, I could have 3 portfolios or 3 different investment choices here in my one InvestSMART account. The beauty of it is that it all counts as one ultimately, even though they're separately invested and have different goals. So you only pay fees on the whole thing. So as soon as you reach that cap of $82,000 in total, you only pay $451 per year, no matter how many different kinds of investment choices you've got. So it's basically all pooled under the one account in separate allocations, but you'll save on fees that way as well. So another question that we've got here from Lutz has written into this one, just saying investment planning, long-term, what is the security of the investment? Example, if InvestSMART disappear for whatever reason. So that's a really good question that comes again back specifically to InvestSMART products. It'll be different for different managed funds or managed portfolios that you may consider. I'll quickly run through just to give you an idea. Let's have a look at the conservative portfolio that I'm going to use to save up for my house deposit. You can see it's allocated into different areas, and we'll touch on this shortly because we're going to talk about diversification. Actually, what we might do is I'll quickly just run back to the slides just so I can show you that module 2, diversification, and also the assets inside that. So by diversification, we're talking about spreading of risk. We don't want to put all our eggs into one basket, as the old saying goes. But then what percentage, in order to diversify, do we put into each kind of asset? Like how much percentage do we put into shares or into property? A great example of diversification is talking about my grandfather. It was great. Like he used to jump in and invest into the share market itself, which is fantastic. But he used to, as most Australians do, they tend to stick to stocks or shares that they know. In a way, they actually don't end up spreading the risk across different assets. So, for example, he got some Telstra shares and he said, "This is great, Tom. I'm invested in Telstra, great Australian company. It's going to help me with my future." But then we said to him, look, what happens if Telstra has, a bad day? And obviously it has had many bad days. He goes, if you got all your money into that one share and it has a bad year, then your entire portfolio is going to be down exactly like that company. So he said, okay, so I obviously need to spread my risk. I need to put my eggs into more baskets. So he went out and bought Commonwealth Bank shares. And he said, well, I'm diversified now. I'm split across two shares. But was he really? Well, no, he wasn't, because he's put his money into a different sector, into obviously banking. But at the end of the day, the Commonwealth Bank is just another Australian share. So more broadly, if there's something that goes really bad with the Australian market, whether it's because of government intervention or the economy isn't doing too well, again, if the market goes down, you're solely exposed to those two shares, then you'll find that your portfolio will probably drop as much, maybe even more, maybe even a little bit less than the entire market itself. So you haven't really diversified again. So just reiterate, one share, you're not diversified. Two Australian shares, so you're across two sectors, not really. So what is diverse? Is it buying 200 Australian shares, having some international shares maybe, or having some fixed interest or cash, so having some other assets? That would be the next steps to being more diverse. So that's what we ultimately told my grandfather, that you need to take some of the eggs out of just those two sectors and start to spread them across into different areas. So going back just to this conservative portfolio, you can see here that we diversify the investment funds you put in across a number of different asset classes or asset types. And when we talk about asset classes or asset types, it can be a bit confusing, a bit financial jargon. Think of it as investments themselves. So what are we actually investing in? And a good example you can see here is Australian equities, which is Australian shares, or international equities, international shares. So not just US shares that a lot of people tend to think about automatically because they think about Facebook or Google or Microsoft, but also other shares that might trade on the Hong Kong Stock Exchange or Singapore, or even London Stock Exchange as well. So you can see here that it's given us a split, different percentages across different asset classes or investments. And because this is a conservative portfolio, so a 2-year time frame, I can invest for 3 years. I don't want to go backwards. So it makes sense that there's a big chunk of it, 46% and 19%, that are sitting in a very defensive asset, which is fixed interest and cash as well. So defensive, not really going to give me a huge return, but to fit my time frame, it's going to be a bit safer for me. But you've still got a finger in the pie of international shares, Aussie shares, and some property and infrastructure. So just going back to Lutz's question about what would happen, for example, if InvestSMART went under. Well, luckily, what we do to give you exposure, or in a sense, how do we invest you into these different assets? We purchase ETFs. So an ETF is an exchange traded fund. So it's a fund that trades on an exchange like the Australian Stock Exchange, Australian Securities Exchange, and it is actually like a share. So I was talking before about diversifying. I could go out, if I want to buy the ASX 200, so that's the top 200 Aussie shares, such names as Commonwealth Bank, all the banks, the big banks are in there, companies like BHP or Afterpay, for example. You've got 200 top Australian shares. I could go and purchase each one through a broker. So I could bring up CommSec or go onto the online platform more likely. I could purchase each one. So it cost me brokerage each time I bought it. And if I really wanted to try and reflect what the Australia 200 index is like, I'd have to buy different percentages as well, because it's a weighted stock index. So it's basically different shares have different percentages that make up the Australia 200, the ASX 200. The thing that InvestSMART does with this managed portfolio is that you own the underlying asset. So just like buying a share, so if you went and bought Commonwealth Bank shares through a broker, you'd be issued with a HIN, a HIN, so a holder identification number. And that basically identifies you as the owner of that share. So no matter what happened to CommSec, they're just the broker, they're your shares, you own them. It'd be the same with this. So when you set up an investment portfolio with InvestSMART, all of these, and these are the ticker codes, AAA, IAF, they are what identifies them on the ASX. So you would end up, you're the owner of all of these. So if InvestSMART went insolvent, it doesn't matter because these are all yours. They're in your name. So that's one of the benefits. The other benefit is if you ever invested in something like this and decided, I don't want InvestSMART managing it for me anymore, I can do this myself, or I'm going to start to slowly unwind, you can transfer these to a broker like CommSec and not have to sell them to get in and out. And that's one of the biggest differences between a managed portfolio and a managed fund, which we'll cover off in upcoming modules as well. Quickly, just on ETFs, there's a question here from Sam. He's saying, what asset class are ETFs? Can they be a total replacement for individual stocks and vice versa? Or should portfolios have a mix? And that's a really good question again. So ETFs are basically, they're usually investment funds. So companies you might have heard of BlackRock, for example, or Vanguard. And you can see we actually use Vanguard ETFs here, such as the property. So VAP, you can actually Google that and it will show you what is inside that ETF. The example I'll stick to though is the BlackRock iShares MSCI Australia 200 ETF, which has the ticker IOZ. So that's got 200, the top 200 Aussie shares. So BlackRock themselves go out and purchase all those individual shares, and then they wrap them up into one product, IOZ, and they trade it on the ASX. And it's basically tracking the Australia 200 or the ASX 200. So if I wanted to buy that as an investor, I can just buy the one ETF and pay brokerage once. I don't have to go out there and pay brokerage 200 times to get exposure to the Australia 200. So in terms of can they be a replacement for individual stocks? Well, that's a good example there of instead of being stuck in just one stock like my granddad was in terms of just buying Telstra, and then if you decide, oh, I might buy CommBank as well, you could purchase an ETF that wraps up 200 shares into the one product. So that's where they definitely do have an advantage. They're very liquid as well, which means that they're quite easy to buy and sell on exchanges to get in and to get out. The other thing as well, you can have numerous different exchange traded funds or ETFs. And going back up to Eureka report, there's actually a filter tool here called exchange traded funds where you can search for all these different types. And we'll actually cover this off in much more detail in an upcoming module. And you can jump ahead and watch the video from that section as well. But basically, there are different types of ETFs. There are some that use scary terms like leverage, which means that they inside will borrow money to make their purchasing power bigger, which can increase the gains, but can increase the losses. So definitely be careful about that. But most of the ETFs will tend to be put together by companies like BlackRock or Vanguard, where they'll have someone either actively, so each day checking, buying and selling, teams of people doing it, or passively, where they're just following, trying to track, get the same returns as the ASX 200. So definitely knock yourself out with all the different research you can look here. There's tons of them. And I'll just have a look if there's any other questions. A question here from Kerry as well. Is there any way that provides detailed information about the ASX 200 for inexperienced investors to study? There is. So we'll cover this off a little bit more as well, but the ASX 200 is just an index that's actually made by a company called Standard & Poor's. And what they're doing is they're trying to track how the market is going in Australia. So the top 200 shares, they're saying this is a good way to track the performance. So they themselves will follow each of those individual top 200 shares and I guess wrap them up in an index. Now on the ASX website, they've actually got more information about indices, and there's so many different types. There's indices that track individual sectors, so like technology sector, for example. There's even the S&P ASX 20, so that's the top 20 shares, top 50, top 100, etc. If we're looking at the top 200, there's even the All Ordinaries as well, which is a much larger index. But if we're looking at the top S&P 200, they've got information here which takes you to Standard & Poor's website. And these are the people that actually track it and monitor it. But the ASX has got a lot of information as well. There's some people who come to do boot camp and we'll even point them back to the education centre on ASX, that just to get a bit more of like a head start into the investing world. But if I clicked on the Standard & Poor's website, it would take me to their website here, where they give you all the information that you could possibly dream of about the S&P indexes that they follow, indices. So we can go through each one of these and look at all their information. They've got research as well, which is quite interesting, just talking about how they work, what's made up of them. That's where I would go, just to get a bit more of an idea about the ASX 200 itself. So what I'll do, I'll just check if there's any other questions. Not yet, so that's fine. And we'll go back to the slides, as exciting as they are. And we've spoken about my grandfather already. We've spoken about the different kinds of asset allocation. So you can see that before we talked about conservative, and it made sense that most of the funds that we'd invest sit in defensive assets. But you can see with high growth that international equities is 43% and Australian equities is 39%. So that's definitely the majority of our investment funds that are being put into equities, which by their very nature are high return, but also a higher risk as well. But because these are diversified, you can see the remaining of the funds that we invest would be split across property and infrastructure. So property and infrastructure covers such things as airports, like Sydney Airport, for example, or any other kind of toll road type investment. Property could also cover off things like shopping centres. There's always going to be an element of cash, and there's always going to be an element of fixed interest, but depending on the kind of portfolio choice you choose, it'll be different percentages. And you can compare this to balanced. So balanced, you can see, has a lower split across the different asset types. At the end of the day, they invest in very similar, in some cases, the same kind of assets, but just different percentages. So it's taken us to the end of this module, and we are bang on time for the 45 minutes. But if you've got questions, definitely go ahead now and ask them, because I'm ready to go. I'll just check and see if we've got any questions here. Great question here from Kerry. I've already watched the recorded webinar for week 1 and 2 and would like to know if you're going to update Bootcamp so we can watch this webinar later. Yeah, and a lot of people tend to do this, and this is perfectly fine. So this will actually go up online too, Kerry, so you can watch it whenever you get the chance, because we do improve them each week, so you'll get a bit more information, and the questions that get asked are just fantastic, and I really appreciate it because it does give me an insight into what you wanted to know about or what we can cover off better. Bootcamp is very interactive. We're trying to make it evolve as we go through, because we do realize that a lot of this stuff isn't the easiest to try and understand sometimes. So on that basis, you've always got these webinars to ask questions. But you can also send us emails as well, or on the website, you've probably seen that little chat icon that's at the bottom right, and you can click on it and ask us questions. And that's on the InvestSMART website. The email, if you ever want to ask us a question, is bootcamp@investsmart.com.au. But I can't see any questions here. So what I'll do is I'll let you go over all the bootcamp content. And if you have any questions, feel free to ask. Any comments, definitely let us know. Any feedback, love to hear it. There's always the review process too when you reach the end of this. So if you think we're doing a good job, let us know. If not, let us know. So I'll leave you with that, and I hope you have a lovely rest of the week, and I'll touch base with you next week. Thank you.